Okay, welcome back to our private debt fund video where we're going to take a deeper dive into what risks are represented within the private debt and the liquid alts areas and why you should think about it. Again, my name is Michael LeBlanc. This is Mike on Money. As always, remember these videos are for information purposes only. Do your own due diligence or reach out to us. We're happy to do a portfolio review, no obligations. We'll take a look at your portfolio of private debt or any other investments that you'd like us to take a look at and give you our comments and our feedback and hopefully help you better position yourself for your goals and your financial needs. So let's jump back into private debt funds. Where we left off before, we were just talking about the general structures and where some of the risk lies and some of the examples of the ones out there that have caught people up either cutting off distributions, reducing distributions, losing money completely, or just not allowing them to redeem out of the fund for much longer periods of time than they expected when going into it. So let's bring things back a little bit and talk about returns. At the start of the last video, we talked about, how are they achieving this 8 to 12% returns when the going rates for quality loans are well below that. So, where does that disparity kind of lie? So the first thing you need to remember when you're talking about a loan or a private debt investment is there's a big difference between returns, or sometimes called distributions, and yield. So yield is what you're being paid, or what you're earning. We use it all the time when we're talking about equity investments. You think of the bank stocks; they pay a dividend. So if you buy a Canadian bank, your dividend yield could be between anywhere 4.5% to 6.5%, depending on what price you pay, and that's a yield. That's actually earnings of that company coming to you. You're earning that money. It's on top of your original investment, right? So if you put in $10 and it's paying 5%, that $5 or 50 cents that you're earning is coming directly to you as earnings of that investment. Debt is different. Think about your mortgage or any loan that you've ever had. Is when you make a payment, there's an interest rate, and when you make a payment, a portion of your payment goes towards paying the interest or the yield, but a portion goes back as return of capital. So that means they're paying down that loan slowly. You're getting your original capital back again. So when you look at your private debt funds or your private debt investments, when you get that monthly or quarterly or annual distribution, you have to look on that statement or in the tax receipts for that return of capital portion, because that's money you're being paid back. So if you put $100,000 in and through the year you receive back $10,000 in return of capital from your yield, that $10,000 wasn't earned. You actually only now have $90,000 loaned out at the end of the year. Working for you, you've received back $10,000. So first of all, that 8 to 12% returns in a lot of cases is not yield. Most of the time, a good chunk of that or a portion of that is return of capital. So you have to really dive in and see what your actual yield is. And why is that important? You say, well, I'm getting my 10% a year. I'm fine. It doesn't bother me. It will, because over time you're eroding your capital's ability to earn that yield. So if you had $100,000 at the beginning of the year earning you 10%, and at the end of the year you had a return of capital of $10,000, you only have $90,000 now earning you that 10% going forward. So over time you are going to erode your yield or your returns on that investment, and over time those investments will erode down just due to the money being returned back to you in forms of return of capital. So you're going to see distribution drop over time, and we're starting to see that. It's been largely masked over the last few years because of the rise in rates of return. So as rates have been rising at the end of every year, these funds have been able to offer you a higher yield, masking the fact that you have had a return of capital. But if we are indeed going into a drop in interest rate environment, and Bank of Canada did the first cut today, of the trend that is expected to continue both here in the United States, that is going to reverse. That benefit that you had with rise in rates is going to reverse. And so what does that mean for you as the fund holder? Well, that means more and more people are going to say, hey, all of a sudden I'm not getting 10%, I'm only getting 6%. I want out of this investment, right? I want to liquidate. Now, the problem with debt portfolios is they don't have a lot of liquidity. You think about your mortgage. You take out a mortgage, someone's loaned you that money, you've spent it on a home, and they come back and say, hey, we need that mortgage money back because some people want out. That's not how it works, right? You've got until the end of that term in order to pay back the principal, and you usually refinance that. So, you've got, if it's a 5-year mortgage, you've got 5 years to pay that back. And that's the same as the debt portfolios, whether it be mortgage portfolios, whether it be private debt, whether it be corporate debt, there's a term, meaning the money's not always available. Now, most of them can handle liquidity by staggering the maturity dates of their portfolios, meaning every month or every 6 months or every 3 months, they have loans maturing that they're able to get capital coming in to pay out those who want to redeem the fund. The problem lies when you have too many people asking. And while the rates have been rising, a lot of people have been more than happy to leave their money in these funds and continue to get those high distributions. The problem is when rates start to decline, and we've seen this on 9-point, just recently, as I mentioned in the last video, 9-point funds had to close redemptions on their liquid alts or their private debt funds because too many people started asking for redemptions. So that means every month they couldn't meet the demand. And the first thing they did is they said, okay, here's how much we have at the end of this month. And every 90 days, so quarterly. They said, oh, here's how much we have at the end of this quarter. The max we're going to send out is 5% of the total fund. And we're going to give that out proportionately to people asking for it out, or to get it out of the fund. Meaning you might have asked to sell all of your $100,000 investment, and you only get $5,000 at the end of the quarter out. You had to wait to next quarter to ask for another possible redemption. And they did that for almost a year till they've cut off all redemptions completely now. So that's the danger in these funds, is they can stranglehold liquidity on you at the time that you most want to get out. And as those rates fall, more and more people are going to want to get out of these funds. More and more people are going to realize there is real rate risk in these funds, there is loan quality risk in these funds, and there is liquidity risk in these funds. And as they become aware of these problems, people are going to start to run to the bank or to the fund and ask for the money out. And that's when even remember, even if your portfolio is quality, they will have challenges meeting those liquidities, and they could put a stranglehold on it while rates are being reduced on you in those loan portfolios. Now let's talk about the loan portfolios themselves. As I mentioned, there are some good actors out there. There are definitely some bad actors, but there's some good actors who are trying to run in a niche environment. So there's basically two styles that these funds will use. One is they'll do direct lending, meaning they will do their own due diligence on who they're lending to, and the amounts they're lending to, and what assets are securing those loans. Those are generally the better actors. I'm not saying everyone who uses the other strategy is a bad actor, but they are definitely the better quality because at least they know what their criteria are. And as long as they hold to that criteria, remember, hopefully they're not reducing their criteria in order to place more and more money as it flows in just to try to keep their yields up. They might be, but at least you can kind of dive in with them and find out exactly what their loan criteria are, what their book exposures are, what the loan book exposure is, and what that means for you. So that's one structure. That's, as I said, I would kind of say is the better structure. The more popular structure, because again, money's been flowing into these funds like crazy. Companies out there have been jumping on the bandwagon to try to offer more and more. They don't have the in-house expertise in order to do all that due diligence. So what they use is what's called the sub-advisors. Sub-advisors are just that. They take your money into a fund. They take that cash that's now in, and they give it to sub-advisors. Could be one, could be multiple. Purpose is a good example. They use multiple sub-advisors. And one of their sub-advisors, 9 Point's the same thing. They use sub-advisors. One of their sub-advisors made some bad investments. 9 Point, recent one. I mentioned the one Bloor West property. They lost pretty much all the money from that sub-advisor to that one investment. So these sub-advisors, again, if your fund company or fund provider is doing the proper due diligence, they are holding those sub-advisors to a standard. A lot of them are not. A lot of them I've spoken to can't even answer what the criteria for the sub-advisor is, other than the sub-advisor saying, we can place $20 million or more, and here's the rate of return we can get for you. So the sub-advisor quality out there is at risk. You might not know it's being held in there. The fund might not know what's held in there, and your advisor definitely probably doesn't know what's held in there. So that's a risk. And when that liquidity crunch comes, those sub-advisors are not going to be able to provide liquidity to the funds. So that's a lot to take in. I want you to take a look at your portfolios. Again, reach out to us. We're more than happy to look at your funds, look at what structure it is, where your loan risks lie, and what the future holds for you. Don't be caught holding these funds when all the music stops. We have a process-driven approach to investing, to identify yield opportunities that can fit your goals that probably involve one in liquidity and stable yields, not returns and return of capitals, but stable yields. So look for some of our other videos out there on high yield investments with full liquidity that might meet your needs. With that, as always, subscribe to the channel, reach out to us for more information, and subscribe to our newsletter. Thank you.